Welcome to FX Options University, recorded live at the International Securities Exchange. FX options are a low-risk alternative to hedging currency moves in any market condition.
So it really depends on whether your options are in the money or out of the money, and it depends on whether you got a debit or a credit. What's your goal? Is your goal to have them both expire in the money or to both expire out of the money? If it's a debit spread and they're both already in the money, then again, you also want time decay because you want it to get to expiration as soon as possible before it has time to fall back out of the money. So spreads are a little different when it comes to time decay. Time decay is a really important element when you're talking about single leg strategies, but when you're talking about multi-leg strategies like spreads, you got to think about it. It's different depending upon whether they're in the money or whether they're out of the money. I don't see any more questions with that. If you guys have any additional questions, unless I missed one, I believe that was all of them, then certainly type them in, and I'll try to address them. It looks like we got about 10 minutes left. In the meantime, I'll mention there are a lot of interesting things about FX options. For the most part, almost all brokers make them available. So if you have an account that's you're primarily an equities trading account or an options trading account like at Schwab, these are really nice because you don't have to open up an account at a spot FX trading firm. You don't have to open up a futures trading account. You trade them in the same account where you trade IBM options or Apple stock or whatever else you might trade. So they're listed securities. They are cash settled in US dollars, as I said, because they are index options. They're European style exercise, which is kind of neat because that means you're not subject to early assignment risk, which is one of the things that you run into when you trade equity options. If you do covered calls or if you do spreads on equity options, every now and then your short leg goes into money, you could get assigned early and it messes up your whole strategy. In the case of a European style exercise on these indexes, you're not going to get assigned early. It won't happen until expiration. And of course, they can be traded as spreads. We know that because we've been talking about that. Are these currency options taxed at 60/40? Ah, great question. You know, I don't think so. 1256 contracts are futures contracts. So when you say are they taxed at long-term gains 60%, short-term gains 40%, that's a question about futures. There are certain securities, most futures and broad-based index options are taxed at 60% long-term, 40% short-term, and these are what's called 1256 contracts. And the reason they're called 1256 is because that's the section of the tax code that covers that. But remember, for non-futures contracts, and these are not futures, they have to be broad-based. Well, think about that. If this is a single currency related to another single currency, that would not be a broad-based item. So unless I'm wrong here, I'm pretty sure these are not eligible for 1256 treatment or 60/40 long-term, short-term gain. So you can check that out if you want. There's a document available probably on the ISE's website, and I know it's out on some of the other industry websites. It's called Taxes and Investing, and it covers all these types of topics. So but I'm about 90% sure that these won't qualify because they're not considered broad-based indexes. Any difference between FX options quoted on ISE and on NASDAQ? Well, the FX options available on the ISE are proprietary to the ISE. I believe they also quote on one of the other exchanges. I think it's the Pacific, which is also the NYSE Arca platform, I believe. I'll let Steve answer that one. I'm pretty sure that's the same contract. But indexes in general and security and options on indexes tend to be somewhat proprietary to the different options exchanges. So it's doubtful that these are fungible. I don't think they're going to be the exact same contract. Now, the underlying concept might be very similar. I know there are other options exchanges that have FX type options, and they are typically similar in terms of how they're structured, where it's one currency relative to another currency. But I don't think they're completely fungible. So I'll actually let Steve answer that question because I think that's kind of more his area than mine. So question about using FX futures and FX options as a hedge. Again, I think I answered this, but I'll cover it again. When you're looking at the aggregate of all of your trading accounts, all of your investment accounts, and you might have an FX spot trading account at an FX firm, you might have a futures trading account at a futures firm, you might have an equities and options account at a firm like Schwab. In your total aggregate, if you're trading these particular index options on a firm like at Schwab, we have no way of knowing or seeing if you have a spot FX account somewhere else, or if you might have a FX futures position elsewhere. So from the perspective of the industry regulations in terms of how we calculate margin, we have to treat it as if these are your only positions, and you'll be subject to the spread margin requirements or naked option requirements or whatever it might be. The reality is that in your total aggregate, you may be far less exposed than the total amount of margin that we have to hold out in your account, but we have to follow the industry regulations on that. So in a sense, from your perspective of a holistic view of all your accounts, then in a sense, yes, you may very well be hedged. But from our perspective in terms of calculating margin, we don't have the ability to look at those other positions. We actually have to treat them as if they're independent positions. So the answer is yes and no, I guess. Question, do you back test your trades? Yeah, back testing is helpful. It's obviously not going to answer all your questions. I always find, I like to use this little statement because I've done it many before. I find it interesting. If you ever listen to anyone who teaches classes like I do, whether it's online or live or anything, we're oftentimes required by regulations to make this statement, and you've seen it printed a bazillion times, and that is that past performance is no guarantee of future results, right, or something very similar to that. You've heard that many, many times. I find that very interesting because the reality is that everything that we do, everything that you and I do as an investor, whether we're buying stock, whether we're trading options, whether we're trading futures, whatever it might be, what we're basically trying to do with every investment we make is disprove that statement. We're telling you that past performance is no guarantee of future results, and yet every investment that we make or every trade we make, we're essentially trying to predict the future, and we're basing that prediction on what's happened in the past. We're assuming that if something has happened often in the past, that there's a high likelihood that it will occur again. We're assuming that if a stock has been very volatile, that it's going to continue to be very volatile. We're assuming that if a stock has been in a downtrend for the last 3 months, that it's going to continue to be in a downtrend for the next month. Some of those assumptions may be correct, some of them may not be. So backtesting certainly has its value. It has its value, especially with options trading, in understanding how options price, the dynamics of how options price, understanding how volatility affects the value of options, understanding how time decay works. For those particular factors that are always going to be a consideration, I think backtesting is extremely valuable. But in terms of backtesting the actual strategy, oftentimes your best backtesting is going to be simply on the stock itself or the index itself in determining if it moved in the amount that you thought it would, and then if it does it again, how that might work out from a profitability standpoint. And with that, I think we've hit the mark. So Steve, I'm happy I had enough time to answer, I think, all these questions. I'll pass it back to you. Okay, well, it looks to me like Steve has had some technical problems and he's lost his audio, so he can't say goodbye to you. Then I'll finish it up. I want to thank all of you for joining us. Be sure to take a look at the agenda that's on the screen right now. It shows you all of the upcoming FX webinars. You can see that these occur about once a week. I get invited to do these. I've done, I don't know, 4, 5, 6 of these, I think, by now. I usually do 3 or 4 of them a year, and I'm always happy to do that. But there are a number of industry experts, people throughout from all sorts of different firms within the industry, different levels of expertise, different topics to talk about that get invited to do these. So by all means, check out the next one, which occurs on October the 12th. So that's a week from today. And with that, I'll go ahead and sign off for Steve Meisinger and myself. Thank you very much for coming.
Visit www.fxoptions.com. ISE FX Options can be easily traded through all options-enabled brokerage accounts.